Welcome to Living Your Greatness. Each episode, we bring on great people to inspire you to achieve your greatness. We discuss topics all related to health and wellness. Listen to world-class stories, learn valuable lessons, and turn knowledge into action. It is now time for you to unlock your inner greatness. Welcome back, everyone, to another episode of Living Your Greatness. This is your host, Ben Mummy, and today I'm actually excited to welcome back Chris Vermeulen. For those of you that don't know Chris, he is a self-made entrepreneur who has founded the technicaltraders.com. Chris is an internationally recognized technical analyst and has been trading technical analysts exclusively since 1997. His mission is to help clients boost their investment performance while reducing risk exposure and portfolio volatility. Through years of technical analyst research and technical trading, Chris has helped thousands of individual technical traders and investors around the world improve their financial well-being. So Chris, welcome back to the show. It is a pleasure to have you with us today.
Hey, thanks for having me.
So Chris, I kind of want to get started here. I was thinking about, from the last time I had you on the show, there was something that I feel we need to share with our audience, which is you published a book called The Technical Trading Mastery, 7 Steps to Win with Logic. So what are some valuable lessons that technical traders and investors can learn from reading your book?
I like to analyze things pretty critically. When I do research, I feel like after a couple of weeks of my intense research that I feel like I've got my 10,000 hours. So, when I go into the markets, I really dive in and I like to tear it apart. And a lot of people, I think, look at the markets from like one or two angles only. And I like to look at the markets from multiple angles, different ways, not just different angles, but using different data points. Because I believe there's a lot more at play than just price action and trends. I think there's psychology behind it, what the masses are doing. There's time cycles. There's volatility in terms of how fast things are moving up and down. We've got, standard deviation is kind of a great way to gauge that. Is something moving beyond its normal deviation? If it has, then you've got to take that into account. You got short-term trends, long-term trends. You've got, what are all the intermarket analysis things telling you? For example, we've got a pretty interesting scenario right now in the markets where all the fundamental and the market internals that I follow are screaming that we are entering a bear market. We are very, very close. The only thing that hasn't turned bearish yet is the price action on the stock market. I haven't fully kicked into a new downtrend on the SP 500. But when you look at all these things, economic cycle, we're coming to the end of that. And I actually have a really good chart that actually shows this. Let me pull this up real quick here. And I'll give you a quick visual of this chart that I had made. And if we just zoom into this middle one here, it's going to show us what the stock market and different things are doing. So this blue cycle here is the stock market. The yellow cycle here is the economy, the economic cycle. And we've gone through this huge rally, massive move. And right now we're at this topping phase where we're starting to see energy, precious metals, basic industry, all these things are really coming to life. They're starting to perform very, very well. And we usually see commodities start to firm up near the end of a stock market cycle. Also, we tend to see inflation kick in. We see the Fed wants to start raising rates. That usually puts a damper in things as well. So we've got all these kind of things coming into play. And so when you bring in cycles, you bring in what other markets are doing, they kind of tell you where we are in the grand scheme of things of the big picture. So the book kind of walks you through the different ways to look at the stock market through time cycles, through sector rotation, through volatility. And those are kind of the key things. And trends, obviously, you need to make sure you're following trends. Moving averages are a great way to do that. And so it's going to show you the market. There's 4 or 5 ways to view it. You kind of want everything to be in favor. You want to be able to identify, okay, this is doing this, this is doing this. We're still in a strong trend, or we're in a topping phase, or So the book's going to show you how to look at the market and then how you can gauge it. And a couple other aspects in the book I find are really powerful are I talk about, you got to trade what you're comfortable with, how you see the market, the time frames. And a lot of people don't understand how to figure that stuff out. And really, you've got to kind of gauge how comfortable you are. If you have $100,000, you put it in the market, what happens if it pulls back 5%? How are you going to feel? What are you actually going to do if I gave you 100,000 right now, and then tomorrow I say, it's worth 95,000? What's your reaction going to be? Or what if it's worth 80,000, in a couple of days, that quickly, right? When you can gauge how your emotions are, how you're going to handle those losses, then you need to understand how to apply leverage or no leverage, very little leverage to the market. Leverage isn't just about 2 times and 3 times ETFs. You can actually go into positions with like 0.75 of a position or half leverage, which means instead of putting your whole portfolio in, you put half of it in. Or you potentially put in, half of your position into the equities market. You put the other half into something that's more defensive, like bonds or precious metals, something that might go up while the other one is going down, so it'll counter it. So I kind of walk you through the technicals and different ways to gauge the market and trying to find out what style of trader you are. Like, are you a swing trader? Are you a long-term passive investor? Until you know what type of trader you are, it's really difficult to hone in to a strategy that'll work for you.
Awesome, Chris. Well, I really appreciate that you give us a recap summary of your book and some of the key learnings that someone can expect to get. And I find that very helpful because, you and I were talking before this call, and I was saying that, I'm more of an investor, right? Where I look at the fundamentals, and an area where I'm weaker at the moment is more understanding like the charts, which is why I follow people like you or Steve Penny or David Brady, people that I think that really have mastered that skill set and kind of understand where it's going. So I appreciate that you kind of explain that, your book shows a perspective to different angles, whether you're a swing trader or as well as an investor like myself. Mm-hmm. So I really appreciate that. And I think it is important for people to consider to get more information on, especially in times like right now where the whole market is super volatile. I think it gives another perspective for us to understand and be in control of our emotions, or at least, even if it's not full control of our emotions, at least better, right? Mm-hmm. Yeah. So one thing I just want to ask for you, some people might not fully understand the term technical trader. So what is that to you? And how has this skill set kept your emotions secure and helped you thrive as an investor?
Right. So to me, a technical trader is somebody who uses technical analysis, which is more or less you look at the charts and you apply technical drawings, trend lines. You look at chart patterns. Obviously, if you get into technical analysis books, you're going to go and you're going to learn about all kinds of technical patterns, bull flags, pennants, cup and handle patterns, all kinds of different things and once you get to know those, then you can look at the charts and be like, okay, well, this pattern looks like a bull flag, and a bull flag is a halfway point on a move. It means it's rallied up, it's flagging sideways. That's the halfway point. Whatever that initial rally up was from the bottom to that flag, once that flag plays out, you can measure that same move to the upside. And so the technicals to me take so much stress out of the markets because you don't need to follow news. You don't need to follow anything else but the price charts. And you got a really good idea just by looking at the charts of how big this pattern is, which means, is it going to take 20 bars to play out from where we are if this pattern continues to unfold? 20 bars is, 1 month. There's about 20 days in a month, trading days. You can also look at the average true range, the ATR of any asset, saying what is the average true range over the past, say, 20 days? It might be, 2% a day or something like that. So you can get a gauge of how volatile it is. Something like Bitcoin or oil recently, those would be a lot higher. They'd probably be like, a 4, 5, 6% move a day, which is a huge move and can do a lot of damage or can be amazing if you're on the right side. But volatility usually means more risk. It means you start to get emotional. Technicals allow me to take the emotional side out of it. I don't feel like it's guesswork anymore. I feel like I know what's coming on the upside. And if it fails, I know what to do and where it's going on the downside. So it allows me to just gauge my risk very clearly, because trading isn't about a whole bunch of stock trades and catching the biggest movers and all the short squeezes and silver and, all these hype stocks. Successful trading is actually about managing your positions. It's all about risk management. When you get in, pulling profits off at partial targets, moving your stops up. It's not about catching one big move and it's over. In fact, a really good way to gauge this is to take a look at this. This I came across a few weeks ago. Can you see my screen there? This here, look at this middle column. Imagine if you made 20% a year. The next year you made 21%. These are killer years. Next year you made 10, still amazing. The next year you lost 16. And that's not too bad at all, considering you just killed it the previous 3 years. You did really well. And then you made another 10%. Those are huge gains. And that's what people are swinging for. And they do a lot of trading. They take a lot of risk to try and get these big trades. Well, what happens if you were to just make a steady 8% every year? You take very low volatility trades, high probability moves. What do you end up in the end? Believe it or not, you can either do the roller coaster and think you're a superhero, or you can be, the steady Eddie and just pick away on a strategy that's consistently, and they both make the same amount of money. And people are caught up with wanting to trade all of the hottest stocks, huge moves. They think if there's a massive move, they should have caught it. The reality is you just need to pull 8% out a year or 15% out a year, depending how good your strategy is, but you just need to focus on consistency. And I got rid of most of my discretionary trading simply because I like consistency. I've programmed my best trading strategies. They pop up on my charts. For example, if I want to go and take a look at the NASDAQ, you can see, you get in, you catch a trend, market starts to get weak, you get out, gives us a new signal, market decided to roll over, and we've been out for this whole crash. And I've systemized it. So I only take the trades that are high probability. I know when to get in, when to get out, and I can do this for all kinds of different sectors. And it's not about taking, 20 trades a year. This is like 3 to 4 trades a year in most cases. And you can generate substantial returns in the teens. And that's what I want. I don't want to be a full-time trader who's at a computer every day monitoring things up and down 10%. That to me is work. That to me is taking high risk. I just want to plug away. I want to grow a large amount of capital. This is for index funds, and just plug away and grow at a steady speed. So hopefully, like this one image here, it just goes to show it's not about trying to hit big trades and thinking you need them. It's about just being consistent and consistent over and over again. So I'm not sure if that fully answered your question or not, but as a technical trader, I can be very consistent using set rules and the technicals versus if you're discretionary, if you don't know what that is, that means you're trading random. You never know what you're trading, and you're kind of just jumping in something because you like it and because it's moving at the time. It's not a really detailed strategy. It's more in your head and you're going off feel. Those can usually be pretty costly. So I systemize it. I'm a pilot, so I love checklists. I like building systems to do everything and try and manage it for you. So it's just kind of plugging away, consistently trading.
Yeah, no, I think that answered my question, because I do think that's the biggest thing that I find is important is sometimes people will try and hop in any type of investment when the party's going, which is usually the wrong time, right? When it's already heating up. So being able to understand those technicals, I think gives you more the knowledge as well as confidence, especially sticking to those rules that you have to be able to get in at the right time, where it's early enough or safest enough, before it starts to heat up, right? Because you really want to get in low and then sell at a high. So I really appreciate that you went through, I think you call it steady Eddie in that chart of one investor, playing it more safe, but actually executing good gains because they got in at the right time. Meanwhile, someone else trying to just look for whatever is going to be hot and kind of going up and down the roller coaster. I've heard of people getting really hurt that way, and then next thing you know, they're holding forever stock that may not even go back up.
Yeah. And the one thing is right now, the current market environment, as it's completely haywire and crazy swings, right now we're getting those big moves all the time. Commodities are on fire. I mean, things are moving fast, right? And the problem is most people want to do a lot of trades because they think it's fun, and it is fun when you're winning. But they like the adrenaline. They want the rush. They think they look at it more like a game. Like it's kind of well, it is gambling, right? And so the problem is this volatility. As you saw from my chart, we get out and we avoid most of it because it's actually really, really deadly, especially for a newbie trader. You're going to get, you might make a bunch of money on a couple of trades. Eventually, you're going to lose it all again. It might not be for 10 more years, but that same thing you made a fortune, like say right now or in 2021, when it doesn't play out and you don't know when to get out, you're going to give it all back down the road. And the worst thing is if you spend 10 years growing your net worth and then in 1 year you lose 25% of it or half of it because you don't understand it, you just wasted 10 years. And so the technicals allow us to be really steady. And this volatility, I like to explain it. It's kind of like a bug zapper light, those glowing lights when a bug goes into it, goes, well, this volatility gets everyone excited. They want to get in, they want to get trading. They think these 5 and 6% intraday swings should be traded, and they can be with day trading strategies, but that's a whole new beast. The shorter the time frame you go trading, the more skill it takes, the higher the chance you're going to lose money. And people, they just don't see that. They want to get in on this action, but this is the worst thing they can do is start to jump in on this. Unless you're a really skilled trader, it's pretty deadly. And the market has this great way of showing this volatility and commodities spiking and taking everybody's money who it attracts, right? That's the way it works.
Absolutely. And I think just to add to those last 2 points too, I do think what I believe is key is for any best investor to kind of see both sides. So I actually believe in having like the technicals yourself. And that's why I'm trying to learn from people like you. And then combining that with the fundamentals of why I'm investing in what I'm investing. But Chris, I kind of want to take this conversation now, kind of lead up to like the whole stock market. So, since you and I last spoke, inflation has gone crazy. And I believe it's over like 7%, right? Calculated. Yeah. But we have also experienced other catalysts, right? We've had some political as well as geopolitical concerns and issues. So my question to you right now is, there's different areas to be right now in the market. It's a pretty freaky market right now to most people. What is your opinion of the overall market right now?
Yeah, if I was to look at the overall market, I mean, we're in cash with our short-term capital. We're very close to exiting our investment capital. Everything right now is screaming, look out below. The market hasn't dropped. It hasn't broken and collapsed yet. I'm not saying it's going to, but it is very, very close. So when I look at the market as a whole, and this is what I call a stage 3. It's a distribution phase. It's where big money is unloading shares. It creates this volatility, this sideways chop. I talk about with subscribers during the last 3 trading sessions, we see the market makers run the market up in pre-market. They drive the price up when volatility or volume's really low. Then the market opens up, and then we see huge selling volume. And that is what we see in downtrends. The market wants to get itself as high as it can. And then when it opens at 9:30 with tons of liquidity, the big money players dump their shares and they just start selling and selling and selling until they're done for their amount for the day. And then the next day they ease off and it drifts up in pre-market. Everybody sees a beautiful rally, and then the market opens and big sellers come back in and they unload. They get to unload at a better price, and so this has been happening repeatedly. It's actually been happening since mid-January. It doesn't happen every day, but it happens quite often. It's blatantly obvious for those who watch it. And anyways, we get into this topping phase, a stage 3. And this is a stage you just got to be really aware of because we're going to start to see the markets break down. And eventually when it does, we're going to see volatility spike, and it's going to happen very quickly in terms of investors don't have much time to react. Typically by the time they react, it's already dropped, it's broken their threshold, and they usually get out near the lows. I think this market could collapse very quickly. I'm scared of one of those like 2010, flash crashes where the market could drop 10, 15%, like in a spike, in a minute. So it's going to be interesting to see how that unfolds.
Absolutely. And that's actually why, Chris, that I wanted to bring you on right now, right? Is I don't understand the technicals enough to be confident. And that's kind of why I want to be bringing on, especially right now where it's such a crazy market, people like you to kind of analyze that. So something that I want to lead to next, if we look at the whole commodities sector, I know in a recent interview you did with David Lynn from Kiko News, you explained that the underlying trend for commodities is starting to come to life, right? Base metal miners and copper miners have done
Yeah.
extremely well.
Yeah.
And now gold miners, I think, since that interview, have done crazy yesterday, breaking and popping. And then silver miners are lagging, but it seems like they're starting to play catch up.
Yeah.
So I know we want to see the equities come to life so precious metals could run higher, and gold and silver miners had a big day yesterday. So do you think that the perfect storm that you've explained in the past, do you think it has already hit or it's just starting to hit?
I think the perfect storm's been brewing for a while. If you were to look at a commodity ETF, like the commodity index, like DBC is a symbol for the overall commodity index. I mean, it's been going up for like a year and it's up huge. Commodities just keep going up and up and up. We're at this phase now where energy and precious metals are starting to really pop and get explosive. And they're usually kind of the two that happen to spike just before a stock market tops out. I think this scenario that we're seeing right now with commodities is a little different than what we saw in 2000. We saw everyone wanted stocks, technology stocks. Everyone wanted real estate. I mean, it was a screaming bubble. The PE ratios were out of whack. No one wanted commodities. And then when it hit that threshold, it snapped. Stock markets, housing market collapsed. And then gold put in a major bottom, went from like $250 to like $2,000. Well, we saw a very similar scenario like that in 2008. In 2007, everybody wanted stocks. They all wanted real estate. Commodities were undervalued, but not as bad as where they are now. And where we are right now is actually that full-on cycle that's actually very similar to 2001 stock market top, where everyone not right now, but I mean, a couple months ago, everyone wanted stocks and everyone wants real estate. It's a bubble in both of those, and no one wanted commodities. And commodities have been creeping up, and now they've kind of really taken hold. And we're at this point where commodities were the most undervalued asset. Everything else was completely off the top end of the charts, very similar to 2001. So we are back in this super cycle stage that I think could last 3 to 5 years for commodities, just based on that cycle alone. But this time, to me, is very different because this time we actually have real supply chain issues from COVID. We're still backed up. We can't catch up to what the world needs. And now you throw the war in there, where Ukraine is 4%, is the fourth largest resource country. It's huge. Now they're coming to a grinding halt where the agricultural side is going to get hit. Corn and wheat, we're seeing those spike up. They're huge on iron. They're huge on all kinds of commodities. They're the fourth largest resource country. And now that's coming to a grinding halt. So we're entering this super cycle for commodities. And now we actually have the COVID problem, which has already started to create commodities to run. Now we got the war, which we're going to have a natural problem of getting commodities because of Ukraine. And then Russia is also being boycotted for everything. People don't want to use their energies. They don't want to use their supplies, which means energy prices will probably want to continue to go up because it's going to put demand on other people who supply natural gas and oil, like the States, Canada. And what's really crazy too is Russia is like, they supply like a third of the fertilizer for farmers. I mean, so if they wanted to, they could say, hey, you're not taking our fertilizer then. That means crops are going to be like half of what they should be or less. And that's going to put even more pressure. So we've got like the COVID, we're behind the ball. We've got Ukraine is now down. That's going to create less product. And now we've got potential, crops. Maybe not everyone can get the fertilizer they need for all the farms because Russia may not supply it, or maybe people just don't want to use it. So there's all these things building into a super cycle, which could create, really scary inflation. I mean, it's, I hope we don't get to the levels I think that it could get to. But it's going to be interesting.
I'm with you on that. I definitely hope not as well. I was driving actually to my CJEP today that I teach at, and I made a gas stop, and it takes premium gas, but still it was at $2.18. Like that's crazy, you know?
Yeah.
And I think
that's per liter because you're in Canada, just like me.
Yeah, per liter. And I couldn't believe it too, because I was like, literally a week ago, or no, 2 weeks ago, I think it was, $1.89 or something. So already it's gone up 30 cents, in 2 weeks. Like, how does that make any sense?
I know I can't believe it. I don't drive anywhere very, very often, but I mean, the fuel prices, I talked to a few people on the ski hill the other day. He has to commute half an hour every day to work. And he's like, the fuel prices are killing me. He's like, I work one day just to pay my gas. And that doesn't include like insurance and maintenance and groceries. Like, it's like the fuel has now become like a pretty big issue. I mean, it was under $1 about a year ago here. It was crazy. Now it's over $2 a liter.
And that's kind of why, again, also I want to have you on here is not only are you a technical trader, but even, you do like the commodities, you do like gold and silver, and those are, also hedges for what's going on with the whole picture right now, right? With the geopolitical, but also even with inflation and all these other aspects right now. So Chris, this actually leads me to my next question, which is, I know you have made a price prediction that gold will rise to 2,700 and then eventually down the road to 7,400. So what makes you have such strong conviction?
Well, the $2,700, that is a really simple technical analysis. The charts are pointing right to it. It really just is the next logical target for gold. It's very doable. It's not that far from where we are. Heck, it's only like $650 away. So it's not that far away. Anything beyond that is really just kind of a real guesstimate. It's a prediction. You can measure it out to some regard. I actually think I measured out with Craig Hemke on a chart, and we actually came, I think, to 7,400 based on going back to the 70s and the patterns that have been unfolding. But we're just commodities are always going to go up in price over time, just like real estate. I mean, cost of living always goes up, or you could say the currency values keep going down. And, I just think we're going to see those eventually rise. We're in this perfect storm with inflation, all kinds of, currency. People are concerned about currencies falling, and commodities in general, I think are just entering this phase that I think 2,600 should be a walk in a park for gold going forward. And I think I talked about this earlier today with somebody where, there's all kinds of different ways to invest. I started in the stock market, started making a bunch of money, started my own health business. And then I moved on. I started Technical Traders after I had sold the health business, and then focused on trading full time, started buying real estate and doing my own real estate. And then I got into annuities a long time ago, which is like an insurance plan on your life, and you can draw from it when you get older. It's kind of like winning the lottery, but you got to pay for it up front. But if you pay for it early enough up front, it gives you a lot of leverage down the road. And then the last investment that is the smallest part of my whole portfolio is precious metals. To me, that is like the insurance in case the economy goes bad or a currency goes bad. And so, I mean, most people talk about gold and silver being 3 or 5% of your portfolio. Some aggressive people say like 10%, which is really, 3 to 5% to me is really all you need, because I'm not expecting the world to fall apart. I'm not looking to make a fortune off gold. But I do think you should have some, because you just never know what the economy will do. And if things do get that bad, then that 3 or 5% will probably jump, 10, 20, 30 times what it's worth, and it'll help counter losses elsewhere. So I like the precious metals space. It's a great investment. It's more of an insurance plan on the economy is the way I see it. But I think everybody should own some, and I think you should have physical. I don't think you should actually like buy an ETF and hold on to it that way. I like the physical. I think there'll be a point down the road potentially where The physical, you'll make way more on the physical because there'll be this giant premium. Sure, gold might be worth $2,500, $2,700, but to actually buy a bar that somebody wants to actually give up, it might cost you $3,200 to buy it. And I think if we were to get up to those crazy levels, 3,500, 7,400, there's going to be some huge price gaps from what it actually costs to buy a physical bar versus just, the spot price we see online, which isn't true to what we actually would buy it at. So I think there'll be a point where you can make a lot of money just on the difference of somebody wanting to buy that physical off you. You could probably make another 10 or 20, 30% on being able to deliver a physical product, because the financial markets are so rigged. I mean, things blow up. People say they have certain inventories, they don't, or they do, but it's only on paper. It's not physical. I mean, brokers have gone broke and taken everybody's money with them. I mean, you got to have something back in a physical asset that if all hell breaks loose, at least it's going to skyrocket in value and be like, thank God I got some of that, right?
Absolutely. And I think also too, we even saw in Canada too, right? There was a lot of political issues going on, a couple of weeks ago, and we don't have to dive deep there, but I was pretty surprised. I've heard before, like that's another good reason, to hedge and kind of have precious metals is we never know what's going to happen, right, with our bank accounts. And I used to kind of think, okay, no, I don't think that's ever going to come true, but it kind of did. We kind of experienced that, right? So it just shows that, there's many good reasons why we should all have it in our portfolio at least, right?
Yeah.
So Chris, I do have a question now. Let's just say, the stock market falls this year. Both traders and investors will probably feel some fear. Do you think they're going to go into gold, if they're not already there yet, like a big pile? And when do you think this situation could play out?
I think most of the world is not in gold. What's his name? Schaefer was in a talk. This is a year ago, but I don't know, but I don't think it's changed much because gold hasn't changed much in terms of pricing, really. He was saying something about 0.5% of the world population has gold in their portfolio. And he said back in the 80s, back at the last major peak, it was about 3.5% of people on average had gold in their portfolio. So almost no one has gold in their portfolio. So we've still got, about 50, 250, 350. We still have, 600% growth of people to start putting gold into their portfolio from where we are right now today. And it's a pretty small market. It doesn't take much to move it. And once the feeding frenzy starts, it should be a pretty powerful move. Once I think if we see gold hit 26, 2,700, we'll probably start to see very strong moves towards it. We'll see huge volume. We'll probably start seeing ads on TV to go hawk your jewelry for gold. We saw last time gold was up there in 2011. Just like Bitcoin was. You saw Bitcoin ads, radio ads, TV ads everywhere. Go buy your Bitcoin with your credit card. It costs like nothing. You can buy an investment.
It was also on like the radio. I was driving, right? And
everywhere. It was absolutely crazy. I remember being at the year that right when it topped out, I remember being at a New Year's party, and I remember surrounded. It was an older resort with older people, and they're all silver hairs. And they're all on their phone and they think it's amazing. They're all buying Bitcoin on their phone with an app. They're all learning how to download the app. They're all buying it. And I can hear it on the radio, like the ads to buy Bitcoin. And I just remember like cringing going, oh my gosh, Bitcoin at that point, like rocketed up to like $20,000. It went like straight up in the last month. And everyone's like a feeding frenzy thinking it's it's amazing. They don't want to miss out. It's like this huge red flag. So I think we're a long ways for that for gold. We'll see it coming. It's pretty blatantly obvious. Bubbles are really tough to time. You never know where the top is, and they can gain some serious ground. The key is knowing when you're in a bubble, then you can start to manage risk and expectations and start to scale out of some of your positions and lock in some gains. But I think we're still a ways from that.
Okay, great. And so because the whole stock market is very volatile right now, how do you think investors and traders should play their cards?
Yeah, it's going to come down to the type of individual you are, how old you are, what you want to do out of it, right? For all we know, the stock market goes into a bear market for 1 or 2 years, and it might take 12 years to come back. Like we've seen it happen before. The NASDAQ took like 15 years to come back. If you're 50 plus, I think you got to be extra cautious. It's not like the COVID was such, the market has a great way of convincing people the market can bounce back very quickly. We saw a 35% haircut and then the market's up like 100% 8 months later. I think that makes people feel like, oh, I'll just ride out any sell-off because it'll come back. And the market's great at sucking people in that way. That's what it does best. The reality is this time could be one of those times where it takes 15 years to come back to the highs we saw back in January or December of this year. And if you don't have 15 years and you're going to start drawing out of your money, out of your investment account over the next 10 years, when it's 40 or 50% lower value, I mean, you're really going to hurt yourself. So I think it's way better to be overprotective, lighten your load, sell some position, because we are very close to seeing the markets get really ugly. And it's way better to miss out on some gains than to lose 20 or 30% of your life savings in a couple of months and be like, why the heck did I not have some protection plan in place? Or buy some hedge that if the market does fall, you've got a small position in there that'll spike in value and help counter the losses elsewhere. But I find hedging myself, I've never been good at hedging. It costs money to hedge. There's actually a cost to it, and it's very difficult to do, in my opinion. I'd much rather move to cash or sidestep the market and put on maybe a bit different trade that'll profit from a sideways market. Believe it or not, when the market goes sideways, volatility can fade. You can play like an inverse ETF and do that. You can also buy bonds. In a lot of cases, bonds will go up while the stock market trades sideways or goes down. That being said, I think the 40-year bond market, this bull market in bonds is probably over. I don't think bonds are going to be that safe haven that everybody thinks they are. In fact, bonds are down, I think, more than the SP 500 this year almost. Like it's not a safe play anymore. So it's all I got to say is, be protective. Don't think this market is going to go screaming to new highs. If it does, and all the technicals get strong, you buy back in and you ride the next leg up. The next leg, if we have one, is about a 25% or 30% rally in the SP 500. So there's lots of upside if we can get legs here. But if it breaks down, we're probably going down 30% from where we are. And that is, I remember in the last major bear market, not 2020, the one before that, people were killing themselves because they lost so much money. I mean, it's serious business when you work your entire life and then you lose. Some of these people losing millions. They might have $1 million. They might have lost 600,000 during the bear market, and people do really scary things. So, I mean, these are important times. And one of these days, we're going to enter a real bear market that lasts a long time, does a lot of damage, and it can really break people and families and businesses and all kinds of stuff. So I'm all about be defensive. I've lived through a bankruptcy once before. So I'm very defensive. I have no problems missing gains, which can drive some people nuts, but I do not like to hold and watch my money just vaporize because I'm too stubborn to move out of it because I'm scared to miss out. Right. So I have a very opposite mindset of 95% of traders. I'd rather miss some gains and step aside than, ride something down because I think there's still upside potential.
I think you nailed it there then with, talking about FOMO, fear of missing out, right? There's a lot of traders that feel that way and they sometimes forget about, they have a war chest that they need to protect, right? Their wealth, right? So they could feel financially well and secure and for their family or for themselves or for their, life or career path. And kind of like you said, when things hit the fan, and I hope things don't happen to people that way, but if some things like that were to play out, it could become a really uneasy time, right? And so
sure.
I do think it is important. And that's kind of why I like having guests like you to not just interview the experts here on, protecting our wealth and getting this wisdom, but also understanding that, if you did really, really well in the last year and a half, and you were in some tech stocks or some other type of companies, you don't need that greed right now. Take
Yeah.
your gains, put it aside, whether it's the cash and kind of wait for like the next kind of crash, or put it into something else like commodities, gold and silver. That's kind of my biggest thing. Is I'm totally with you on that. Is I'd rather play it safe right now and have that contrarian mindset to kind of set myself up for success.
Yeah. Yeah. I agree for sure.
So Chris, you have been a mentor to thousands of technical traders and investors. So what do you believe separates a good investor from a great investor?
I would say it comes down to mindset, which is what you kind of keep touching on. It's like, well, mindset of an individual and expectations of how the markets actually work from what they're thinking. So many people see the market as fast money. They got to trade a lot. They expect if there's a huge move in something that it should have been traded and you should have made money. But the way the markets actually move and work, and the way properly managing money works, you can't always just catch huge moves that just happened on news. I mean, those are anomalies. Those are actually high risk trades. If you're in some of those positions and they happen, they can be amazing quick windfalls. I think what sets people apart is understanding, just like that first chart, that graph, that table I showed you, it's just about trying to find low risk, consistent setups, pull out 1 or 2% a month, 1 month with your portfolio, get in, take it, move out, wait in cash, wait for the next one, get in, make 1% on your portfolio, get back out. It may not sound like much, but if you're doing it on your entire portfolio, if you can get in 3 or 4 trades a year that make 1% or 3 each time, you've just made your 10% a year. You're dodging a lot of downtrends in markets because you're stepping out when the technicals are breaking down. You're managing your risk. So you really just got to attack the markets going for consistent gains, not going for grand slams. If you're going to go for those grand slams, which are big, fast movers, your position size better be like really, really small, because that's what's going to hurt you. And then they'll be like, I hear it all the time. It's like, well, then I'm not going to make any money if I put in a small position. Like, if they want to get into something that moves super fast, like get into, say, oil for a 10% move. And I'll be like, well, it's moving 10% right now. So whatever your normal position is, you should probably trade like 1/10 of it or a 20% of what you normally would put in a crude oil trade, because it's way more volatile than what it normally is. And they're like, well, then I'm not going to make any money. I'm like, yes, you will. You're putting in less money, but you'll make the same amount as if you trade the same amount on a low volatility trade. People just don't get it. It's the same with high priced ETFs. I'll issue a trade on an ETF. They'll be like, oh, I'm not going to take that trade. I don't have enough money for it. It's too expensive. And I don't know if I'm missing something, but to me, it just makes me cringe, because it's like, what do you mean you can't afford it? If it doesn't matter if it's a $1 stock and you buy 10,000 of them and it goes up 5%, you still made your 5%. Or if it's a $10,000 stock and you bought 1 share and it goes up 5%, it doesn't matter. You make the same amount. Who cares what the share price is? So people have this perception that a high share price, they can't buy enough shares. It's the dollar value you're investing. It's not how many shares you own that are going to make you money. So there's these huge misconceptions that people just, for some reason, completely miss. And it really comes down to managing your positions, your risk, and all position sizing. If it's volatile, trade less. If it's volatile, avoid it. One of those two, pick one. Right. So, but the problem is everyone does the opposite. They move in, they trade a lot because they can make a ton of money really quick. And then you wake up with bad news and you're like, oh my gosh, I just took a beating. I don't want to trade anymore. So it's tough, because it's human nature to do the opposite of what you should do in the stock market. So it's not anyone's fault. It's just the way we're wired, and the markets are designed to make you emotional and really make bad decisions.
Gotcha. And from what I understand here, to be that great investor, if you could try and develop systems, rules to get you to be a steady Eddie, and have those consistent gains, those are the ones that are going to stand out with time. Right. And I even think, like, even if we talk about like great financial mentors or heroes in the world, right? Like even Warren Buffett, right? He's got his systems, he's got his things that he invests in, he has his rules.
Yep.
It's small, consistent gains. And over time, that's what got him where he is, right?
Yeah. Yeah. Rules, consistency, sticking to what seems to work, right? It's what you believe in, what you see. I mean, what I trade and the way I see the market, somebody else sees the market totally different. They trade it a different way. The crazy part was back when I had another trading partner, we would trade together and I'd go long, he'd go short, and we'd both make money. It'd just be absolutely crazy because I'd be trading a bit different time frame than him. And so he'd get in or get out at a different time. And same would I. So would I. And it's just crazy that we could go at the exact same time and we could both make money on the opposite trade. It comes to managing those positions, knowing when to get in, when to get out. Getting out is the hardest part. People don't want to sell a winner and they don't want to sell a loser because then they're a loser. The markets are brilliant at taking people's money. And so people will hold on to a position, especially in a volatile market, until it gets down enough that they can't bear it anymore. And then they panic and sell out. And it's usually near a market bottom when, all the indicators I have on my charts, I've got custom indicators that are reading the panic levels throughout different markets, the New York Stock Exchange, the volatility index, a bunch of different things. And I can see when everyone is freaking out. And I tell subscribers all the time, I'm like, this is it, guys. Everyone's crapping their pants today. We're probably going to bottom in the next 3 days. And then we'll be looking for the next best trade to get into once we have a confirmed bottom. And I mean, they love being able to know that, because a lot of them are nervous too. They're holding their own portfolios and positions, but they always say, it's so nice to hear you say that everyone's panicking. These are the signs of a short-term bottom. So I provide a lot of guidance through those emotional times. Even when we're out, people still need my guidance or want my guidance because it allows them to manage their other money that's, outside of our newsletter type of thing.
So Chris, a question that I want to ask you that I never had the opportunity or I didn't ask you it last time I had you on the show is, as you know, the purpose of this podcast is to inspire millions of people to achieve greatness and enhance their overall personal well-being. So what is your definition of greatness?
I think greatness would be doing something you love, which for me is the stock market, inventing and trying to help others make money. I love being creative and taking somebody with an idea. I love steaming up like an idea. I'm like, okay, well, you could do this, you could do that, you could do this, and you could turn that into a business. Like I love creating things, right? So doing something you love to me is very important. Doing what you love and being able to help others. And the reality is, like, we're in the markets, the financial markets, to make money. We all start businesses to make money. The reality is, to me, greatness is if you can make a bunch of money, enough money that you can live a really good life, and then have enough that you can go and help others, which is what I'm trying to do with a program you and I have talked about in the past called Early Start, helping kids become entrepreneurs and successful and understand. I think that's super important because the reality is, you need money. Like you can't live without it. That's the reality of it. So if you can help others and help them live a better life, help them see that they can do something they're passionate about and make a living so they can support their family, then hopefully give back and help others. That to me is like the ultimate greatness. And you see that among so many wealthy people who have reached levels of success. All they want to do is give back and help because it feels so good. It's just amazing to watch and see smiles and see people going through these waves of, success. And the journey to success is so much fun. It can be humbling at times. It's not an easy path, but it is fun. And so I think going full circle, being born, starting something, creating something new, and being able to give back and help others is kind of the whole circle of greatness.
Chris, I think that's a beautiful definition of greatness. And it's funny because, I've had so many guests on the show where I've asked this question and, I don't know the percentage, but a lot of them have said that is achieving greatness yourself, getting to a high level, whether that's financially, kind of like what you just said, or whether that's becoming, a high class athlete, right? But then giving back, right? So that athlete, for example, giving back to maybe coaching later or, doing stuff in their field, right? And you've even seen that with like Michael Phelps, right? He gives back with his organization for mental health, for swimmers, right? And so even in the finance sector as well, you see that as well with many greats, right? Like financial greats. And one of my previous guests, his name is David Arsenault. I'll have to link you to, but he pretty much actually had the same common thing of you. He kind of said like, it's pretty much like the circle of life, which is what you just said.
Right. Okay.
So, so I appreciate that. And Chris, I was wondering, who is a future guest that you'd like to see on the show?
A future guest. I don't know. There's, I don't know. It's funny because I'm kind of all over the place with people, like things that I'm listening to. I'm doing podcasts. I'm doing YouTube shows. I'm into, into all kinds of different spiritual stuff. So, I mean, I'm embedded in the financial industry. And I mean, as much as I love it, I don't really actually want to hear more financial people talk. I actually just started going to the gym again with my wife, and I had a personal trainer the last 3 days, and he's an athlete. And I know you do a lot with athletes. And so he was telling me that he competes, like he does bodybuilding bodybuilding, I think. Anyway, so I was asking him about it today, and in my head, I was like, it would be actually really interesting to listen to somebody in just the bodybuilding space, just because it's so interesting. I mean, I went keto about a year and a half ago. I lost like 50 pounds. I feel amazing. And now I'm like thinking, you know what, I really want to kind of really push the athletic side. I'm big into kiteboarding. I kiteboard every week in the summer here, foiling and surfing and all that stuff. But now I'm thinking of actually taking it to the next level. So I realized over the last 2 days, talking with him about this new training plan we're working on, that I know very little actually about, fitness and how the muscles work and, all the different stuff. I mean, his stuff went over my head. He knows so much. It was more of a blur for me. I got the gist of it, but diet and the exercising routine, I think, is pretty cool. So somebody in the fitness would be, I think, kind of interesting, an eye opener for me.
Well, I have some good news for you, Chris. I accept that challenge because this Friday I'm going to be interviewing Kelly Dell, and he does the mental fitness performance side, which is a lot about mindset of kind of getting into falling in love with fitness, treating it like a relationship, right? Like a relationship with a friend or a wife or whatever. But that's how most people don't look at our fitness or physical activity routine. So anyways, his name is Kelly Dell. So I'll make sure after that interview to send it your way.
For sure. It was funny because today I was talking to the trainer, and I was like, I want to come in, like my old routine from like college, like forever ago, was like, I come in, I go on this machine, this machine, this machine. I have no downtime. I loop, I do them 3 times, then I go to the next 3 machines. Like, I don't want to, I'm in a rush. I'm always in a hurry. I don't want to just like stand around for 2 minutes and cool down. Right. I'm like very efficient. Right. I'm like, I want to get to the gym, get my workout, get out of here. So I told him that. And so we were doing this routine, and I found it, I was telling him, I don't want the gym to become a job. I don't want to be huge and muscular, and I don't want to have to come all the time. And when I stop, I just fall to pieces, right? I lose everything. And so I thought it was interesting because after today's workout, I had a connection where I actually really liked it. And now I actually want to go to the gym, and he showed me a whole new side. And now, weight training is more cardio. I didn't realize it was so cardio. My heart was pounding. I'm dripping in sweat. And usually I go and I do the incline trainer for an hour and read or listen to a podcast. And so now I'm actually feel inspired. And it feels like something I want to do, versus my mindset 2 days ago was like, I'm going to do it for a few months. It's kind of a job. I'm going to try and get a little bit more fit. But now it's turning into like this passion where I want to go. It's been a real game changer just the last 2 days. Any professional help, if you hire a professional, I mean, it really does make a difference. You really understand what you're doing. If you don't understand something, you generally get frustrated and you give up. But now that I'm starting to see it and have professional help, it really is actually turning into I think the gym is going to be more of a hobby. Like I like it. I'm passionate about it. I want to go.
That's good. I'm really excited to hear that, and congrats. And it sounds like you're going from a investment bug to now a gym bug. So,
Yeah.
so you're kind of hopping around. That's awesome. Congrats. Awesome, Chris. So Chris, I do want to be mindful of your time, but I do want to end off with, where could our listeners go to connect with you online?
Sure. Yeah. Well, they can go to thetechnicaltraders.com. And then on there, I share my screen every morning, depending on the newsletter there. I share my analysis of the charts. We talk about what's going on. I try and kind of gauge the market movements, how it's going to affect any positions we're in, or potentially give us new positions. It's very educational, 100% technical analysis. So if you want to read charts and watch charts and be able to gauge where something should go, it's a great way to do that. And I focus on, I'm not a stock trader. I don't pick a whole bunch of stocks. I focus on ETFs, indexes, bonds, sectors, commodities. And we look to squeeze the market for a few percentage gains with every trade. And by the end of the year, it adds up to, 10, 15% on average, and rinse and repeat year after year. That's it. Avoid the chaos. That's the game plan.
Awesome, Chris. So I will be sure, just like last time, I'll make sure to drop that in the podcast notes.
Great.
So everyone knows where to go to find you. And I do want to announce too, I do look forward to one of the next times having you back on for us to talk about your other passion, which is early start. If people are looking, already right now to find out more about that, where could they go?
Sure. Yeah. They can go to earlystart.com. It's spelled like an Earl, like a website, URLY start.com. And it's all about helping kids and really just entrepreneurs in general build an online website around something they're passionate about and turn it into a hobby that could turn into a business. And my daughter now has a couple of websites. It's crazy. She does live streaming shows almost every night. And she does what I do. I'm like, be quiet, I'm going on a show. She's got a little light studio booth. She does gems. So she orders in gems in bulk from the wholesaler. She does these gem live auctions and sells gems live. And she talks to these people, they talk back. It is pretty amazing. I mean, she is doing exceptionally well, and she ships everything. She's learned to do it all. So she's really gone. Last time you and I talked, she was selling dog treats online, homemade dog treats. Now she's importing stones and then selling them. This spring, we're going to a mine where she gets to go and you pay a fee, and then you can go collect and keep all of the stones you want, or you pay by the pound. So we're going to go have fun, collect our own. It's a special spot where they got all kinds of gems and mineral stones that she can pick up and polish and sell herself and stuff. So it's pretty cool. So that's earlystart.com. And yeah.
Awesome, Chris. So I'll also include that as well. And I just want to end off. Thanks again for being here today. Always a pleasure to chat with you. You're definitely someone that's very passionate about what you do.
Yeah, great. All right, we'll take care and we'll talk to you soon.
Thank you for listening to the Living Your Greatness podcast. If this show has added value, please subscribe, leave a rating, and make a review. This podcast is for informational purposes only and is not to be considered personal, legal, or investment advice or a recommendation to buy or sell securities or any other product. It is based on opinions, current events, press releases, and interviews, but is not infallible. It may contain errors, and Living Your Greatness offers no inferred or explicit warranty as to the accuracy of the information presented. If personal advice is needed, consult a qualified legal, tax, or investment professional. Do not base any investment decision on the information contained on Living Your Greatness or our videos.